All right, today we're going to discuss possibly the number one investment out there in the markets right now. And before you roll your eyes, okay, just hear me out. First of all, this video has no edits, so grab a drink, calm down. I'm not going to be like clipping stuff and adding memes or whatever. This is just going to be a discussion about the numbers, the company, and the number one investment that I see in the markets right now. It might not sound like much, but I want you to give me an opportunity to give you the argument, okay? So over here, we're looking at, hold on. Oh, there you go. Black & Decker, ticker symbol SWK. Hear me out, please. So first, let's take a look at some of the numbers here. At a glance, this company is worth about $11.4 billion. PE ratio at the moment is 11.02, although you're going to see varying numbers anywhere from 10 to 30. 4P is 17.24. These numbers are not that meaningful, but as we dive into the numbers, you'll see what's going on. Let's just first look at some recent performance, all right? So the company has experienced a very massive slide downwards to a price that it hasn't really even seen since 2013. October 28, 2013. So it's been a while. 10 years to be precise, almost. And what is causing this? Well, perhaps it is the slowdown in the housing market causing a lot less demand for tools and whatnot that Black & Decker is known for. And it's presenting us with possibly one of the greatest investing opportunities right now. And why do I call it the greatest? Are there more undervalued companies out there? Yes, of course. You can look internationally and you can find a ton of them, but this one is an American company. And you could argue that there are better opportunities out there, and I'm willing to have that argument. But first, let's just look at some facts, okay? This company has literally been around for 150 years, okay? Look at this. Founded 1843. More than that. 107. What is that? I can't even do the math. It's the number is that high. 186 years. That's crazy, right? So the company's been steadily growing and has been paying out dividends for a very, very long time. In fact, it hasn't only been paying out dividends, it's been increasing the dividend payout over a long period of time. If we look at the dividend tab here, now I'm using stockanalysis.com. Of course, I'm not affiliated with anything. I just like the website. So the dividend yield for this company is 4.28, and I want to talk about that. I want to come back to that number and talk why I think that's important. Annual dividends 3.19 on the stock if you want to do the math. Payout ratio at the moment is 44.6. Now, they've had a bad recent quarter, and they're going to have a worse one soon, which may present us with a even better buying opportunity than right now. And I'll show you how to play that possibly. Dividend growth is 4% per year, which is, somewhat on pace with inflation. This is a list of the dividend issuances over the last, 10 years or so. And this is that charted on a graph. You can see that their dividends are ever increasing. Okay, and they've only increased a penny because they kind of overdid it in 2021 because of the surge in the housing activity and whatnot. All their department stores, the Home Depots of the world and stuff that sell tools like Black & Decker were really busy around everybody wanting to renovate their house or fix up the house that they just bought, me included. So they experienced a really big surge in revenue and profits, and so they try to increase the dividend. It could bite them in the back because now they're probably having to issue shares or go in debt to pay some of these dividends. But regardless, I think they might make it on the other side of this and keep increasing the dividend every year. I think they've done it for maybe the last 50 years or something like that. It's crazy. It's insane. So this might be the first time they don't do it, but even if they don't do it, I think this is still a really good opportunity, especially if the price of the stock keeps falling a little. So today it actually fell 3.45%, and it could go down further in the next after the next report, or in the next coming few months, and then the opportunity will be just like mind-blowing. Now, let's take a look at some numbers. All right, let's take a look at some numbers. I like to go and look at the quarterly report. Break down the numbers in quarterly figures so I get more definition as to what's going on. The revenue drop off in the last 4 quarters hasn't actually been that substantial. It's dropped from 4.4 billion to 4 billion. That's not a huge drop. So revenue is actually not doing terrible. Let's take a look at net income. Net income is minus 45 million. These numbers look a little bit jumbled up. This number is way too high. This number is way too low. I don't know if they're doing some number massaging or whatnot, but or they're deciding to like write off a lot of stuff or what have you. But this isn't really a big deal. This kind of stuff has happened before. In 2018, they also had a negative quarter. But they will, even if they have another negative quarter in the near future, and if it's deeper, they're gonna bounce back. All right, this company is not gonna go and decide to all of a sudden, bankrupt or whatever. I know it happens to very old companies all the time, but even if that does happen, even if there's a chance that happens, the brand is gonna stay alive. Someone's gonna buy the brand. The company will get bought out at some low price, and you're not gonna get zeroed out. It's just not going to happen. So there's some margin of safety in that. And there's even more margin of safety if the price keeps dropping. Now, shares outstanding diluted. It looks like they're issuing a few shares as of late, probably to pay the dividend, which is fine. They're going to bounce back from this downturn in the housing market. And when it does turn around, whether it's soon, whether it's in a year or two, or what have you, it's going to be violent because there's been pent-up demand, housing-related pent-up demand for the last year, and it's going to probably persist for another year or two. I don't know how long, and things will equal out at the end for this company. Now, dividend per share, you can see here how the increase is just another chart of the dividends. But what I want to point out here is the gross margin is dropping. Gross margin is dropping, operating margin is dropping, and profit margin is in the negative at the moment because they had a losing quarter. Basically, the difference between a gross margin, operating margin, profit margin is just each one of them gives, it's further down the chain of accounting, basically, and profit margin is the one that, counts the most. It's after everything that you need to be accounting for. So let's go to the statistic real quick because I want to show that, this isn't the full picture. The market cap of a company is $11.4 billion and the enterprise value is 18.46. This is concern number one. All right, concern number one is that they are like $7 billion in debt. And for a company that's, valued at 18.46, that's a lot of debt. But it's not new, okay? Let's go to the balance sheet short version so you can see what we're talking about here. So they have 400 million sitting in the bank right here. Total debt is 7.6 billion. So net cash is 7.06 billion. So $7 billion in the hole. It's a lot. Like there's no question about it. Let's explore this issue further. Here it is, quarterly, so we get some more definition. This is how cash has traveled in the company, the cash balance, and total assets over here. But I want to contrast it to the debt. So let's go to total debt, and you'll see that this is not actually the highest debt burden they've had. They've had debt in the beginning of 2022 of $11.1 billion, and they've been decreasing it a little bit, which may actually not be the brightest thing. I hope they're retiring high interest debt. But what I would really be interested in, and I might actually click on the 10K, I would encourage you to click on the 10K and the 10Q to find out what interest this company is paying on this debt. My guess is that they're actually paying pretty low interest because only recently did the Federal Reserve hike rates, which increased the cost of capital for many of these companies. But this debt was accumulated when the rates were low. Okay, so basically they're winning the trade on debt, right? They basically sold debt when it was high, when it was valued very high, and now maybe they're buying it, right, when it's valued low, when the interest rate yields are high, because the price of debt works in inverse. Okay, that's my impression of inverse. It works, the price of the debt works inverse of the yield that it gives. So it's actually working out in their favor. I don't think they're going to be in trouble, is what I'm trying to say. But I want to bring our attention to something else here. I want to circle back to this number here, the dividend yield of 4.28%. Now, 4.28 might not sound too much. You can get more than that just leaving your cash in a brokerage account or in short-term treasuries, where you can get over 4.4% on your cash right now. Okay, just in a month or something like that. But what happens is, when you go further down in time and try to get the same type of return on longer term bonds, like 2-year, 3-year, 4-year, 5-year, 10-year, 30-year, the percentage is actually, the yield is actually not that high. It's lower. So the yield at the moment is actually inverted. Okay? Or how did Tom Cruise do it? I don't know. Okay, inverted. So the short-term debt is actually paying more than long-term debt, anticipating deflationary periods ahead. So if the 30-year bond is paying less than, the 4.4% or whatever, then how do we lock these high rates for a longer period of time? Well, one way to do it is to buy a company like Black & Decker. Okay, because their dividend is 4.28, and that dividend is probably, most likely, very high percent chance, is going to grow over the next 30 years. So this is much better, and I would argue probably even safer than, okay, that's a stretch, but it's pretty safe. I mean, it's going to grow and it's safe, and it's a way to lock in this yield for a very long period of time. Okay, so and it doesn't matter what the price of the equity does from here on out, because this dividend has a high chance of staying the same. Now, in the short term, could it get knocked down if things stay static in the housing market, and this whole renovation, system that we have going on here coming to a halt? Yeah, it could happen for a year or two, but it's not going to stay like this forever. Okay, these guys really want to increase their dividends each year, and they're going to do it. Now, okay, we have to be cognizant of the fact that each dividend has to be backed up by earnings. Okay, and they do have a lot of debt on the books, which I discussed. I don't think is that big of a problem, even though the debt is huge. It's kind of like, if you're a household and you're carrying a low mortgage, on your books, you can still prosper, right? You can still put money away. You can retire some of that mortgage. You can still do well if you're conservative enough. You can outlast the tough period, and eventually, whether through inflation, okay, or what have you, that debt might get burned away, right? As your earnings and revenue increase over the years and your debt burden stays the same, the debt is nominal. Okay, it's not real, it's nominal. So it will get burned away over time. And it'll be easier and easier to pay it off as time goes on. So I'm not that concerned about it. Okay, but we have to acknowledge that these issues do exist. So that's my argument. Okay, we lock in this 4 something yield, and we ride it out, okay, for 30 years together. Okay, and this dividend will increase. And what's really important is your cost basis when you bought in, right? It's not important like what the price is gonna do, 20 years from now. Might be double, might be triple, doesn't matter. Our cost basis is this. We're gonna be collecting this dividend based on our cost basis, and we're gonna be just money. It's way better than leaving it in bonds, where the yield will probably actually get, what will stay the same for 30 years. But you never know what the future holds with the bonds. So you could get a better, I don't know, better deal, worse deal, who knows. But at least this way you know that these guys will not want to reduce the dividend. Other things I wanted to mention. Okay, so all right, Slav, but how the hell do we play this? Okay, so this company is potential. It's got a lot of potential. It's got the brand name. It's got the history. You got 50 years or something of increasing dividends. So that's all good and gravy. How do I get in? Do I just buy the shares right now? Well, first of all, you go into your brokerage account. Now, don't clown on Robinhood. Don't do it. I know you're some sophisticated investor that would never look at a brokerage house like this. But I don't want you to sleep on this app, okay? This is my public account, and it's very simple to understand, so that's where I do all my examples. Don't be elitist prick, okay? They're fine. They're secure. SPIC insured. You know what I mean? FDIC. That may hold your trading for a day, but they're not going to lose your money. You're more likely to lose their money. Okay, so we're going to go here, and we're going to click on Stanley Black & Decker. So this is the year of chart performance, a great opportunity. This is the 5-year chart. You see that it's lower now than it was in the depths of the March 2020 crash. It's lower now, right? It lived through this period. It boomed a little bit in 2021 and has been on decline ever since, rightfully so. What we're going to do is we're actually going to put this on our watch list, okay? On the lower part here, we're going to add it to our list. I'm going to add it to my opportunity list, and we're going to watch it. If you think it's a good deal now, all right, what I suggest you could look into. By the way, none of this is actual financial advice. All financial advice is individual. I'm not a professional financial advisor. All the risk you take is yourself. All the risk taken is just by yourself, okay? I'm not responsible for any loss. So you're going to click here on trade options for SWK. And what you could do, let's say you really like this price, but you're not ready to buy. You can go out, like a month and a half here. Go to May. Okay? And let's say, the price right now is 74.47, but you want an even better opportunity to enter. You could sell a $70 put, okay, for $250. What do you need for that? You need $7,000. You need $7,000 available in your brokerage account. Can you use margin for that? Yes. Do I suggest using margin? Only if you have a ton of money into your account. If you have $3,500, $3,500, and you want to use up the entire available $7,000 in order to sell a put on SWK, it's probably not the greatest idea. I mean, it's an idea. It's not the worst idea, but it's probably not the greatest. Okay? So if you have a lot of money, sure. If it's not going to set you back financially, if you lose some, sure. So you click on this, right? You add it, you continue, boom, one contract, $250. Okay, it's going to credit you $250. Review order. It's going to say here that you need a collateral of $7,000, and then you submit. Okay, I'm not going to submit now because I don't want to buy it at this point. I'm going to wait for it to go lower and then maybe I'll buy it. I'm going to have to compete with Apple if it drops too. So that's what you can do. And look at this. So if this doesn't hit, right? If the put option does not execute, which means the price of Black & Decker will stay above $70 by May 19th. What's going to happen is you're going to collect these $250 and you're going to get your collateral back. Now, $250 for a month and a half is a really good deal. Okay? Let's do some quick math on top of my dome here. So 10, that's times 250, that's 2,500. Plus another 500, so that's what's 3,000 for $7,000. So I mean that's a lot. Am I doing this right? 250. Oh, it's not times 10. Sorry. Okay, so it's like two. All right, so over 20%. Okay, so over 20%. Yield yearly if you annualize it, or somewhere around there, a little bit over 20%. That's really good. Okay, that's a really good yield. 20% yield is killer. So even if you don't get your stock, you're gonna at least know that you're gonna be getting yield that's equivalent to a 20% annualized, and then you're gonna get your collateral and look for a better opportunity if this one doesn't play out. So you could do this, and you can add yourself that way a little bit of margin for error and pay yourself while you're waiting. So that's an option. You could do that. If you don't want to risk missing this opportunity, then you can just go into the markets and just buy the stock. Buy however much you're comfortable with, and let it play. And it's definitely a long-term hold though. And I do think that the stock has a potential to drop down further, especially since the market seemed to be, not buying this huge breakout in the S&P. And then maybe a correction coming. I'm not a chartist or a technician, so I don't know for sure that that's going to be happening. I would consult your local chartist or technician for, their timing expertise and magic. I do not have that. But I do go on just experience, feel, volume, and just how things tend to work out in the markets, news cycles and sentiment and things like that is the kind of things I watch, and I just get a feel for it. It's not very scientific. I would never advise anyone follow my timing metrics, so you're gonna have to try to make a determination based on the price that's presented to you today, unless you think you have some kind of an edge in timing these entry points. Perhaps you do, perhaps you don't. That's up to you to figure out. Again, it's your decision. You got to make the decision. I'm just telling you what I think about this. All right. Black & Decker, super old company, dividend. You can lock it in for a long period of time and just let it ride for like 20, 30 years. Definitely a long-term investment. I mean, you could try to make a short-term play out of it if you want. It's up to you, but that's what I'm seeing. And this is my, idea for number one investment right now in the markets. Okay, period. I'm done with the foreign stuff. I tried. Okay, tried investing in Chinese stocks, in Russian stocks. It didn't work out too well. So my Russian investments got locked up and lost everything. I was like, oh, I'm so smart. I'm just gonna buy down here, when there's blood on the streets. But there was too much blood on the streets, so much that it spilled over all my investments, and now, boom, money gone. Chinese investment, same thing. Alibaba, undervalued. JD.com, super undervalued. VIPS, VIP shops, extremely undervalued. Lost money on all of them. All of them, I got some of them back, but net loss, like 30,000 or something like that dollars. So, foreign investments, tough, very tough to deal with it. A lot of political risk, etc. So this is an American company, huge history. You can't go wrong. Watch something super wrong go with the company. Let me know if you have this company. if you are hearing what I'm saying, or if you completely disagree, I don't care. I want to hear about it. I mean, I do care if you completely disagree. I want to hear your counterpoints. Let me know in the comments what you think about this, and if really is one of the top or the top opportunity right now in the markets. This was a long one. Peace out.